Hello. This is the 40th deep dive of What Would Peter Lynch Do? Exploring the wisdom of legendary investor Peter Lynch. We had a great question from a listener who asked, I heard that supply and demand fluctuates on Four Witches Day. What does this mean? How does it affect stock prices? And that's exactly what we're diving into today. We want to unpack this really fascinating market event, understand the mechanics behind it, and figure out what it actually means for you, especially if you're newer to stock investing.
Precisely. Yeah, this deep dive is all about unraveling the mystery behind Four Witches Day, or as it's more formally known, Quadruple Witching Day. We'll look at where it came from, how it shake up the market, and really importantly, how someone like Peter Lynch might advise us to think about it, maybe even navigate it. We want to show you why it's maybe not just noise to ignore, but potentially a genuine opportunity.
Okay, let's get into it then. What exactly is Quadruple Witching Day, and where did that very captivating name come from?
Right. So think about basic contracts, an agreement to buy or sell something later at a set price. The stock market has its own versions called derivatives. Quadruple Witching Day is, simply put, the specific day when four types of these derivatives all expire at the exact same time. The nickname, Four Witches. It paints this picture, right? Four witches showing up together to stir the market pot, make things a bit volatile.
Huh, okay. I get the imagery.
And it happens like clockwork. In the U.S. market, it's always the third Friday of March, June, September, and December.
Okay, the third Friday of those 4 months. And what are these four witches, these four types of derivatives?
Good question. So number one is stock index futures. Think contracts tied to big indexes like the S&P 500 or the NASDAQ 100. Second, you have stock index options. These give the right, but not the obligation, to buy or sell an index at a certain price. Third are single stock futures, similar to index futures, but tied to shares of one specific company, like, say, Apple or Tesla. And finally, number four, single stock options. Again, the right, not the obligation, to buy or sell shares of a specific company.
Got it. Four types: index futures, index options, stock futures, stock options. So the listener asked about supply and demand being shaken. What does that actually mean when all four of these expire together?
Yeah, supply and demand is really just a way of talking about the balance between buying pressure and selling pressure in the market. When we say it gets shaken on Quadruple Witching Day, it means that normal balance gets thrown way off. The push and pull between buyers and sellers gets super intense, and this leads to stock prices moving much faster and often much wider than they normally would.
Why does the simultaneous expiration cause that, though?
Because it forces investors holding these contracts to do something. They can't just sit on them anymore once they expire. It's kind of like the last day of final exams, multiple project deadlines hit at once. You have to submit or maybe ask for an extension or, well, you fail.
Okay, makes sense. You're forced to act. What are the options for investors then?
Basically three main paths. One, they can just close the position, which usually means selling the contract before it expires or letting it settle. Two, they can roll over the position. This is huge for institutions. They close the contract that's about to expire and immediately open a new similar contract, but with a later expiration date, so they maintain their exposure. Or three, physical delivery. Depending on the contract, this means actually buying or selling the underlying stock itself. So if your contract was to buy 100 shares of Apple, now you must buy them.
Right, or sell them if you had a contract to sell.
Exactly, you have to deliver.
So it's really the sheer volume of everyone doing one of these three things at the same time that creates the chaos, like a bottleneck.
That's the perfect word for it, a bottleneck. You have potentially millions of contracts expiring, triggering these actions, closing, rolling over, physical delivery, all hitting the market simultaneously. It creates this huge flood of buy and sell orders. Imagine like everyone trying to cram through one narrow exit door after a concert. Total congestion. And that congestion leads to these wild, unpredictable price swings, especially near the end of the trading day. That's the shaken supply and demand.
Can you give an example of how that rollover maybe affects things?
Sure. Let's say a big pension fund holds a massive amount of S&P 500 futures contracts expiring in June, maybe because they expect the market to go up. If they still think the market will rise, they'll roll over. So on Quadruple Witching Day, they sell their June contracts in huge volume and simultaneously buy September S&P 500 futures contracts. This action alone causes futures trading volume to just explode.
Okay, futures volume explodes. But how does that hit regular stocks?
Ah, the ripple effect. The market makers or other investors on the other side of that giant futures trade, they now have to adjust their own positions to manage their risk. This might involve buying or selling large amounts of the actual stocks that make up the S&P 500 index, like Apple, Microsoft, Amazon, especially those with the biggest weighting in the
I
index.
see. So the futures trades force buying or selling of the underlying stocks.
Exactly. Particularly in the final hour of trading, you see the volume in those big stocks surge and prices can swing sharply. It's a classic case of the market mechanics, the supply and demand, temporarily overpowering everything else.
Okay, so just to recap quickly. Quadruple Witching Day, third Friday of March, June, September, December. 4 derivative types expire.
Correct.
Supply and demand shaken means huge volume, wild price swings because everyone is forced to close, roll over, or physically settle millions of contracts all at once.
You've got it. It's usually a short-term disruption, doesn't typically dictate the market's long-term direction, but yeah, definitely means extreme volatility for that day.
So if the market mechanics are so powerful, can the stock price of even a really good, solid company fall just because it's Quadruple Witching Day?
Yes, absolutely. That's exactly right. And it's a key point for investors, especially long-term ones. Even a fundamentally fantastic company can see its stock price drop simply because of these market forces, not because anything changed about the company's value. And often, it's the big blue chip stocks that get hit harder.
Why them specifically?
Well, two main things are happening. First, you have this temporary battle where the force of supply and demand just overwhelms the company's fundamentals. Investors aren't thinking, is Apple a good buy today? They're thinking, I have to process this expiring contract. It's purely mechanical trading.
Okay, mechanics over fundamentals for a short period. What's the second force?
The second one is arguably bigger. It's the massive influence of index-based derivatives. Think about those S&P 500 or NASDAQ 100 contracts we mentioned. Top companies Apple, Microsoft, Google, Amazon, Nvidia, they make up a huge percentage of these major indexes by weight.
Right, market cap weighting.
Exactly. So when massive amounts of index futures and options expire, the trading activity naturally concentrates on the stocks with the biggest weights. Imagine, say, a large institution has to sell a huge block of S&P 500 index futures. The market makers absorbing that might hedge by selling the actual S&P 500 stocks. And because Apple and Microsoft have such large weightings, they become the prime candidates for selling pressure, proportionate to their size in the index.
So it's like the best students in the class getting caught up when the whole class gets detention.
That's a great analogy, yeah. They get dragged down by the overall market action tied to the index, even if their own story is positive.
And options expiring. Does that add to it?
It can, yes. Think about call options, the right to buy a stock. If Apple is trading at $190 and you hold call options giving you the right to buy it at $200, those options are worthless at expiration. Now, the investors who sold you those options might have been holding actual Apple shares as a hedge against having to deliver them if the price went up.
But now they don't need that hedge anymore.
Precisely. Since the options expired worthless, they might sell those Apple shares they were holding, adding more selling pressure.
Wow, okay, so for someone just trying to invest long-term, what's the takeaway? It sounds like these price moves are just noise.
Largely, yes. For a long-term investor focused on company value, the price swings on Quadruple Witching Day are mostly short-term market noise. They don't reflect the company's intrinsic worth. Honestly, nobody can reliably predict whether prices will go up or down overall on that day, but you can be pretty certain there will be extreme volatility. And here's the key part. Echoing maybe what Peter Lynch would say. If a great company's stock gets temporarily pushed down because of these technical factors, well, that could actually be an opportunity to buy it at a discount.
That brings up a really interesting point. Why do people even make these complex trades? Derivatives seem complicated. And why make them all expire on the same day? That seems to cause the problem.
Excellent questions. They really get to the core of why these markets exist. People treat derivatives for generally two main reasons: risk hedging and profit seeking.
Okay, risk hedging first. Like insurance.
Exactly like insurance. That's the fundamental purpose. Derivatives let you reduce the risk from future price swings you can't predict. Think of a huge pension fund holding, say, $10 billion in stocks. They might worry about a market crash. Selling all those stocks would be incredibly expensive and difficult. So instead, they can sell stock index futures. If the market does fall, their stock portfolio loses value, sure, but they make a large profit on those futures contracts, which helps offset the stock losses.
So it's like financial insurance.
Perfectly put. Or like a farmer selling their future rice harvest today at a fixed price to avoid the risk of the price collapsing later.
Okay, that makes sense for big players managing risk. What about profit seeking?
That's the other side. Speculation, really. And it often involves the leverage effect, the ability to control a large asset value with a relatively small amount of capital. Let's say you're convinced Tesla stock is about to soar. Buying 100 shares at maybe $200 costs you $20,000. If it goes up 10%, you make $2,000. Not bad. But what if you bought a Tesla call option instead? Maybe that costs only $500. If Tesla stock does surge, the value of that option could jump to, say, $2,000 or more.
So you spent $500 to potentially make $1,500, a 300% return.
Exactly. Huge potential return. But, and this is crucial, if you're wrong and Tesla stock doesn't move or falls, you could easily lose that entire $500 investment. High risk, high reward.
Definitely high risk. Okay, so hedging and speculating, but why coordinate the expiration dates?
That wasn't some grand design from the start. It actually evolved sort of naturally over time, driven by the need for standardization and efficiency. It started way back with just single stock options. For convenience, markets settled on the third Friday of each month as the standard expiration day.
Okay, that was the first step.
Then, in the early 1980s, stock index futures and options came along and got really popular really fast. To make things simpler, avoid confusion, and improve efficiency across the markets, they decided to align the expiration of these new popular index products with the existing standard that third Friday. That's when we got Triple Witching Day.
I see. Combining them for efficiency.
Right. And then the final piece, single stock futures, were introduced in the 2000s. And following the same logic, they were just integrated into the same system, same efficient third Friday deadline.
And that made it quadruple witching.
And that completed the set. It's kind of like a school deciding it's just easier for everyone, students, teachers, administration, if all the major term papers are due on the same day, rather than scattered throughout the month. Standardization for efficiency.
Got it. So are these trades the derivative? Are they only for the big institutions, or can regular individual investors like me get involved?
That's a really common question. And the short answer is no, it's not only for institutions. Individual investors absolutely can participate. However, and this is a big however, there's just a world of difference in the scale, the purpose, and frankly, the influence between the two groups.
How can individuals get access?
Usually through online brokerage accounts, there are trading platforms. But because derivatives are considered very high risk, brokers require you to jump through some hoops first. You usually have to specifically apply for options or futures trading, complete some mandatory educational material about the risks, and often maintain a certain minimum account balance, sometimes called a basic deposit or margin.
Okay, so there are safeguards. But assuming you meet those, you can trade.
You can. But comparing institutional and individual trading in derivatives is like, well, it's like comparing a giant aircraft carrier to a small surfboard in the same ocean.
Aircraft carrier versus surfboard.
Yeah.
Explain that.
The institutions, the aircraft carriers, their main goal is often that risk hedging we talked about, protecting massive portfolios worth billions. Their trade sizes are astronomical. They are the ones making the waves, creating the supply and demand shifts, especially on Quadruple Witching Day. Plus, they have teams of analysts, super fast computers, complex algorithms, just overwhelming information and tools.
And the individuals, the surfboards.
Individuals are generally in it for the profit-seeking, that leverage effect, trying to make a potentially big return on a smaller investment. Their trade sizes are tiny in comparison, making virtually no impact on the overall market. They're using publicly available news, standard brokerage tools. They're not making the waves. They're trying to ride the waves the institutions create.
So it's really the institutions driving the quadruple witching phenomena.
Absolutely. They create the volatility. Individuals can participate, trying to navigate that flow, but they don't cause it.
So following that analogy, it really sounds like for most individual investors, maybe you don't need to be out there on the surfboard in that particular storm.
Yes, exactly. You've hit the nail on the head there. That's the core insight. For the vast majority of individual investors, trading derivatives is not just not essential. It can actually be an incredibly dangerous area that, frankly, they don't need to get into.
Why so dangerous? Beyond the leverage,
Well, several reasons. First, remember the zero-sum game idea. Unlike investing in a good company where ideally everyone can win as the company grows, a positive-sum game derivatives are much closer to zero-sum. For you to win $1, someone else generally has to lose $1. And in that game, who are you playing against? Often, it's those institutions, the aircraft carriers. It's statistically very, very hard for an individual surfboard to consistently win against them.
Right. The odds are stacked against you.
Hugely. Which leads to the second point. It's an overwhelmingly disadvantageous fight, a tilted playing field. They have vastly more capital, way better information, not just public news, but deep analysis, sometimes proprietary data and trading speed that individuals just can't match. Winning consistently requires immense skill, deep knowledge, probably a good dose of luck, too. And complexity.
That's the third thing. Derivatives are complex. An options price isn't just about whether the stock goes up or down. It's affected by time decay, how much time is left until expiration and implied volatility, how much the market expects the stock to move. You could be right about the stock's direction and still lose money on the option if, say, time runs out or volatility drops unexpectedly. And with some derivatives, like futures, your losses can actually exceed your initial investment.
Okay, that sounds scary. So if it's so risky and tilted, why even learn about it? Should we just ignore it completely?
No, that's the nuance. Even if you decide, wisely in my opinion, not to trade derivatives yourself, understanding that they exist and how they impact the market is really important. Why? To understand the market's movements. Quadruple Witching Day is the perfect example. Imagine you own shares in a great company. On Quadruple Witching Day, the price suddenly tanks. If you know nothing about derivatives, you might panic. Oh no, something terrible must be happening with the company, and you might sell at the bottom.
But if you understand the context, if you understand that this is likely a temporary distortion caused by massive derivative expirations, completely unrelated to the company's actual health or prospects, you can react rationally. You might think, okay, this looks like that quadruple witching effect. The company itself is fine. Maybe this temporary dip is actually a buying opportunity.
That makes a lot of sense. Know about it so you don't misinterpret the noise.
Exactly. So your initial thought was spot on. For most people, the best path isn't trying to master these complex, risky tools for short-term gain. It's focusing on the long game. Steadily accumulating ownership in good businesses, letting them grow your assets over time. Derivatives are a powerful, potentially dangerous tool you probably don't need to use, but you absolutely should know about their influence so you can be a smarter, less easily spooked investor.
Okay, focusing back on the impact. Which companies tend to get hit hardest by this volatility? You mentioned large caps earlier. My intuition might say, okay, big institutions hold big positions in large cap stocks, so they'd be the main targets, make them more volatile, right? Or could be the opposite. Are large companies just so massive, so liquid, that maybe their volatility is actually lower because they can absorb the flow better?
That's a really sharp question, thinking about both sides. But your first instinct is much closer to the reality on Quadruple Witching Day. It's the mega cap blue chip stocks, your Apples, Microsofts, Nvidias, Amazons, Googles that are really center stage and often experience the most significant volatility spikes.
Okay, so the biggest companies get the biggest swings. Why?
Two main drivers we touched on earlier, really amplified here. First, they are the key components of the indexes. Remember, a huge chunk of the expiring derivatives are index-based, like S&P 500 futures and options. When you trade an S&P 500 future, you're effectively trading a basket of all 500 stocks, but the impact is weighted by market cap. So the giants like Apple and Microsoft represent such a large slice of the index that any large-scale index-related trading like those massive rollovers or hedges inevitably concentrates its firepower on them.
Got it. The index structure funnels the action towards the top.
Precisely. And second, these large-cap stocks are the core holdings of institutional investors. Institutions manage vast sums of money. For liquidity reasons, needing to be able to buy and sell large amounts without drastically moving the price, and for stability, they tend to overweight their portfolios with these huge established companies. So when they need to hedge their overall portfolio risk using derivatives, or when positions related to these core holdings unwind, these large cap stocks are the natural place where the action happens.
But what about that paradox? Aren't these big companies supposed to be the stable ones?
Normally, yes. On a typical trading day, a mega cap stock is like that aircraft carrier, small waves barely move it. It takes a lot to cause a significant percentage change. But Quadruple Witching Day isn't a normal day. The volume and force of the derivative-driven trading isn't small waves. It's more like a giant tsunami, as you said earlier. This tsunami is so powerful, generated by the mechanics of expiration, that it can shake the entire aircraft carrier. Ironically, smaller company stocks might actually be calmer on this day because they're further away from the main path of these huge institutional index flows.
That's a great way to put it. Like the chaos concentrated at the central train station during rush hour, while the smaller local stops are quieter.
Exactly. It's the central hub, the large cap stocks, that experiences the most intense congestion when all these major derivative train lines converge on expiration day.
Are there exceptions? Other types of stocks that get volatile.
Sure. Occasionally, you might see extreme volatility in a specific stock if, for instance, it's being added to or deleted from a major index around the same time as Quadruple Witching Day. That forces index funds to buy or sell it in huge quantities. But generally, the main event revolves around those top-tier large caps. Their very size, which usually gives them stability, paradoxically makes them the primary target for absorbing the massive external shockwaves from derivative expirations on this specific day.
Okay, pulling this all together then, it really seems like the smartest thing for an individual investor to do is not try to play the complex derivative game, but rather view the volatility created by others as a potential chance. A chance to maybe buy shares in those great companies you've been watching, but at a temporarily cheaper price.
Yes, exactly. That is absolutely the wisest, most desirable conclusion we could reach from this whole discussion. That captures the core perfectly. It's the most ideal stance. Instead of, risking getting swamped trying to surf these massive, unpredictable waves of derivative trading, it's a strategy of calmly walking the beach after the storm has passed and picking up the valuable shells, those fundamentally sound blue chip stocks that might have been temporarily washed ashore at a bargain price.
I like that, picking up shells after the storm.
We could even call it something like the value investing strategy using noise.
Okay, why is that the best approach for individuals?
Well, first, you're fundamentally shifting the game you're playing. You're moving away from that difficult, arguably stacked against you zero-sum game of trying to predict short-term, mechanically driven price swings. And you're firmly planting yourself in a positive sum game. Long-term ownership of businesses you believe will grow and create value. That's a game where individuals actually have a strong chance of winning over time.
Makes sense. Play a game you can win.
Second, it embraces the wisdom of Benjamin Graham's Mr. Market analogy. Remember Mr. Market, the manic, depressive business partner who sometimes offers to sell you his share of the business at ridiculously low prices. Well, Quadruple Witching Day can be one of those days when Mr. Market, purely for technical, mechanical reasons, gets depressed and offers you shares in a great company at a silly price, totally unrelated to its real worth. A wise investor, Graham taught, takes advantage of that bargain sale.
Right. You use Mr. Market's irrationality to your advantage.
And third, it puts you in control. It shifts your mindset. Instead of being a passive observer, maybe getting scared when prices plunge, you become an active investor who sees potential opportunity in that volatility. You're taking the initiative.
Okay, so if someone wants to try this using the noise strategy, how should they approach it practically? Any tips?
Definitely. A few key steps can help execute this wisely. Step 1 is preparation. You need to have your shopping list ready before Quadruple Witching Day arrives. Know which fundamentally sound companies you'd actually like to own more of. It's too late to start researching when the market's already going wild.
Have your list ready.
Okay. Step 2 is price setting. Decide in advance roughly what price range would make that stock attractive to you. I'd be interested in buying more of company X if it dips below $150. Having a target helps remove emotion when the moment comes.
Set your price target. Got it.
Step 3 is execution. Don't try to time the exact bottom. Nobody can do that reliably. Instead, approach it with split buys. If you decide to buy, maybe do it in 2 or 3 smaller chunks rather than all at once. That averages out your purchase price and reduces the risk of buying right before another dip.
Split buys, not all at once. Makes sense.
And finally, step 4 is mindset. You need patience. The market might not give you the price you want on that particular day. Don't be disappointed if the bargain sale doesn't happen for your target stocks. Just stick to your plan. Opportunities to buy good companies at reasonable prices always come along eventually for patient investors.
Good advice. Prepare, set prices, split buys, and be patient.
Exactly. So for the individual investor, avoiding the whole complex, risky world of derivatives trading, and instead strategically using the short-term market inefficiencies created by others, using that noise to gradually build positions in excellent companies you want to own long-term at potentially better prices. That's just a much more comfortable and likely more successful path.
So how does this align with Peter Lynch? What did he actually say about this kind of situation?
That's the perfect question to bring it home. This whole idea of using volatility as an opportunity lines up perfectly with the core philosophy of Peter Lynch and really all the great value investors. Now, you probably won't find a quote where Peter Lynch specifically says, on Quadruple Witching Day, you should. He was much more focused on understanding the individual company's story, its earnings growth, its niche, not so much on predicting macroeconomic events or these short-term technical market movements.
Right, he was a bottom-up stock picker.
Exactly, but his entire investment philosophy gives us a crystal clear answer about how he would view this. Peter Lynch absolutely would have seen the price swings on Quadruple Witching Day as nothing more than noise, temporary fluctuations completely disconnected from the underlying business reality. And crucially, he would have argued that for an investor who has done their homework, this noise can actually be a gift.
A gift? How so?
His advice, applied here, would likely follow these lines. First, don't confuse a stock price drop with a company going bankrupt. He always stressed this. A price decline on Quadruple Witching Day is purely technical, driven by supply and demand mechanics, not a reflection of the company failing.
Right.
From his view, it's noise you should basically ignore if you're focused on the business. Second, he'd say, ask yourself why you own the stock. If you bought it because you believe in its long-term growth, its strong fundamentals, its competitive advantage, then why would you sell just because the market had a temporary seizure?
Right. If the story hasn't changed, the price drop is irrelevant to the long term.
Exactly. In fact, if your belief in the company is solid, he'd see this price drop like finding your favorite brand of clothing suddenly put on a massive, unexpected sale. You don't question the quality, you might just buy more.
Huh. Good analogy. And the third point.
Third, and this is classic Lynch, a downturn is a great opportunity to buy excellent companies cheaply. He said this over and over. Market crashes, corrections, even just temporary dips like this should be viewed not with fear, but as chances to load up on quality. He has that famous quote, something like, if you thought a stock was good at $14 a share, it's a wonderful thing when it drops to $6.
Yes, I remember that one.
You understand the company, you know its financial condition is fine. Buying at $6 and selling later at $22 is a much more amazing return than buying at $14 and selling at $22. Applying that logic, a great blue chip stock temporarily knocked down by quadruple witching mechanics, that would have been a prime buying opportunity in his playbook.
So it fits perfectly with this philosophy.
Perfectly. And it's not just Lynch. This thinking echoes through all the value investing giants. Think Warren Buffett. Be fearful when others are greedy and be greedy when others are fearful. Quadruple Witching Day, with its potential for sharp drops driven by mechanical selling or fear, is exactly the kind of situation where Buffett would say a rational investor should be looking to be greedy, meaning looking for bargains.
And Benjamin Graham's Mr. Market again?
Yep, Buffett's mentor. Graham's core message with Mr. Market was, don't get caught up in the market's daily mood swings. Your job isn't to predict them, but to exploit them when Mr. Market acts foolishly. The market on Quadruple Witching Day is Mr. Market having one of his irrational fits, throwing away good merchandise for technical reasons. The wise investor, Graham would say, should gladly take advantage of his temporary insanity.
So the consensus among the greats is clear.
Absolutely. The common voice is, short-term market volatility is not something to be predicted, but something to be utilized. It's not a threat to fear. It's a potential opportunity to embrace. Your conclusion earlier lines up perfectly with decades of their collective wisdom.
Okay, but that sounds so obvious, doesn't it? Buy good companies when they're cheap. If it's that straightforward, why do people still talk about Quadruple Witching Day? Why do markets seem to get nervous about it?
That is such an important question. It really highlights the classic investment truth. It's all easier said than done. The advice, buy good companies cheaply during dips, seems obvious, almost trivial. Yet the market does get jittery around days like Quadruple Witching. Why the disconnect between simple logic and real-world behavior? Well, part of it is that different players in the market have very different games and perspectives. For short-term traders, hedge funds, institutional desks managing derivatives, Quadruple Witching Day is a real battlefield.
No.
For them, the volatility isn't just noise. It's where they see intense opportunity and significant risk. They might be trying to profit from tiny price discrepancies, arbitrage, or make bets on short-term moves. It's high stakes, high stress.
And operational risk, too, right? You mentioned managing those huge positions.
Exactly. For a fund manager responsible for rolling over billions in futures contracts flawlessly, it's incredibly tense. A small execution error could cost millions. It's like that pilot docking the oil tanker in a storm requires immense skill and concentration, so their nervousness is understandable.
Okay, so it's a big deal for the pros directly involved. But what about long-term investors? Why would they get nervous if they know the principle?
That's where the battle between reason and emotion comes in. We know the logic, but our human psychology often gets in the way. First, there's loss aversion. Psychologically, the pain of losing money feels much stronger than the pleasure of gaining an equal amount. Seeing your account balance drop sharply in real time on Quadruple Witching Day, even if your rational brain says it's temporary noise, still triggers anxiety and fear, it just feels bad.
That gut feeling overrides the
It
logic.
can. Then there's that nagging doubt. What if this time is different? Even if you know about the technical factors, a little voice might whisper, maybe this plunge isn't just derivatives. Maybe there's some terrible news I don't know about. That uncertainty can erode rational plans and lead to panic selling.
And maybe the temptation to join the frenzy. FOMO.
Absolutely. Fear of missing out. Seeing prices swing wildly might tempt even a long-term investor to think, maybe I can just jump in quickly and ride this wave for a fast profit. That desire for quick gains can easily distract from a patient, long-term strategy.
So institutions have their reasons, individuals fight emotions. Any other factors?
Well, there's the role of the financial media and analysts. Let's be honest. A calm, quiet market doesn't make for exciting headlines. Headlines like Quadruple Witching Day arrives, market braces for turmoil, or volatility explodes as derivatives expire. Those grab attention. This constant framing reinforces the perception that it is inherently a tense, dangerous day, even if the underlying advice for long-term investors is simple.
So the narrative feeds itself.
Pretty much. It becomes a self-reinforcing cycle. So that simple advice, buy good stocks when they fall, is a bit like saying exercise regularly and eat healthy food. Everyone knows it's the right thing to do, but actually doing it consistently, especially when faced with temptation, like market panic or junk food, is really hard. Quadruple Witching Day becomes this symbolic day where the different interests of various market players clash most sharply, and maybe where an individual investor's own internal battle between reason and emotion fights most fiercely. It just underscores how difficult it can be to apply even obvious investment wisdom when real money and real emotions are involved.
Wow, that's a really powerful way to frame it. Okay, today we've had a truly insightful deep dive into Quadruple Witching Day, looking at what it is, why it happens, and crucially, what it means for your investments. And a word from Peter Lynch today, really, is that his core principle here connects not just to investment decisions, but almost to life wisdom, wouldn't you say? Understanding what's just noise versus what's truly significant, and maintaining your long-term perspective through short-term bumps, that feels like a powerful lesson, whether you're navigating the stock market or just, well, life's own fluctuations. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.